Well, the U.S. economy added 253,000 non-farm payroll jobs last month, coming in hotter than analyst estimates. The latest employment data points to a resilient job market amid banking turmoil, rising rates, and elevated inflation. Here with what this all means for the U.S. economy, we have Thomas Simons, Jefferies money market economist. Good to have you on the show, Thomas. So I don't think any of us were really expecting it to come in. We were expecting a kind of a cool jobs report. Didn't get that at all here. I want to get your main takeaways and your reaction here.
Yeah, I think the data was somewhat mixed, but overall, you're right. This month's data was quite strong. Really, it's some odd downward revisions that we got to the February and March numbers that showed that it looks like the labor market started to soften then, but it actually picked up a little bit this month. I think when you look under the hood, there's a lot of encouraging signs in terms of the strength of the labor market. Some of the sectors that we saw job losses in the previous months eked out some modest gains. And a lot of the increases in payrolls that we saw were in sectors of the labor market that tend to be relatively high paying. So from the point of view of the consumer and the economy overall, it's a good thing. From the point of view of the Fed, as you mentioned at the top here, it complicates things. It makes it significantly more difficult for them to achieve their goal of getting inflation back down towards the 2% target.
And in terms of giving us some context into the types of jobs, you mentioned a couple of the sectors there. Strong gains in services. A lot of these were some of the harder hit industries due to the pandemic coming back. Is there a concern that it might be hiding perhaps some of these slower performing industries like manufacturing, which isn't quite seeing the same gains?
Yeah, manufacturing is having a tough time now. You know, we see in the monthly data, whether it's hard orders data or in the ISM surveys, that new order volume is down very significantly. You know, the consumer spent a lot of money on goods, durable goods specifically during the early days of the pandemic. They borrowed forward a lot of that demand, and now they just don't have a need to buy as much stuff as they did before. The manufacturing sector is still working through a lot of backlogs, however. You know, there's still tons of stuff that was in short supply back then that, you know, they're still filling orders. So there is current activity that needs to be addressed, and manufacturing is one of those sectors that tends to be relatively high paying as well. But what I was really thinking about more was in healthcare, in financial services, even in mining to an extent. There's some good progress there, and the sectors that were most hit the worst, I suppose, during the pandemic is really the leisure and hospitality sector. So a lot of food services and accommodation type employees. That's the only sector in the private sector that still has a gap between the current level of employment versus where it was in February of 2020. There's roughly 400,000 fewer people working in that industry than there were back then. Part of that, of course, is because their businesses were destroyed and that sort of thing. But also a lot of those people have moved out of that sector and into other higher paying jobs. It's one of the reasons why wages overall have been on such a strong trend throughout this recovery.
And we know the Fed also watching wages closely as well as this jobs report here. What kind of position does this put the Fed in now?
It puts them in a very difficult position because they have multiple things that they're trying to manage, and the strategies that they need to manage them are seemingly at odds with each other, right? So the biggest issue is, at least as far as what looks like the near-term downside risk for the economy, is the stress in the banking sector. It's eventually going to lead to significant contraction in credit, it seems like, which could be a big problem for small businesses who borrow very heavily through regional and local banks in order to start up. We've already seen that start to take a hit on job openings. The JOLTS data earlier this week showed that small businesses pulled back a lot in job openings. But we're only sort of at the beginning of the process of seeing the labor market weaken such that we can get slightly lower wage growth that ends up, again, translating to lower inflation over time. At the other end is, and the strategy that the Fed needs to address this is continue to keep rates high for a while. On the other hand, you have these issues with the banking sector that are almost exclusively linked to the fact that rates rose so fast and so high. So, do you cut rates to save some of these banks or at the risk of having inflation reaccelerate? To this point, the Fed has decided to try to take a strategy with addressing the banks by the balance sheet through liquidity and loans, to the banks versus keeping interest rates high to try to slow down demand and inflation. So far, it looks like, the jury is out on whether or not they can do that. And manage both problems heading in different directions at the same time with the same tools.
And then you add to that, I mean, you have a consumer who's been relatively resilient so far, but how long can they be resilient? When is that going to start to pinch with inflation and with the fear of recession and tighter lending conditions all sort of boiled into one?
Yeah, I think later on this year, it's really all going to kind of come to a head. So in the near term, it's really inflation that's still a big problem. The consumer worked through a lot of excess savings over the course of the last year and a half in order to try to keep up with inflation, because obviously wage gains, though strong, are not as high as inflation was. They can only do that for so long. There's only so much excess savings to work through. And really, a lot of that is concentrated in relatively wealthy people now at this point, too. Couple that with the fact that it's very likely that we're going to have up to 45 million people starting to pay back their student loans again later on this year, probably in September or thereabouts. That's a pretty significant hit to their disposable income, and thus it's going to weigh on spending quite a bit. So I think as we get into that later part of the summer, we'll see more of the cracking in the labor market that follows along with a slowdown in consumer spending, because U.S. consumers are extremely resilient, but they can only handle so much for so long.
Indeed. We knew the cracks would come at some point as inflation continues to be more persistent. A big thank you there to Thomas Simons there, Jefferies money market economist. Thank you for joining me this morning. Have a great weekend.